Hey guys, welcome to Make Money Count. CPI numbers came out.
They did.
Lower than expected, or lower than I thought they were anyways. Tariffs
Are still in play,
yeah,
but not to the extent that they used to be.
Right. There's been some.
Okay, so lots going on right now. Most importantly, for people in variable rate mortgages or considering variable rate mortgages, let's talk about CPI. So this is what I would like to do. I want to talk a little bit about the CPI number, which came in. April's reading was 1.7%.
Right.
Which on the surface seems amazing.
Right.
Like Bank of Canada's target inflation rate is in that 2% range. It actually seems as though like 1.7 should be a really good reading. The problem is, and we've talked about this, we've spoken about this many times, there is a difference between the general CPI number, which includes the entire basket of goods, of which there are 8.
Right.
And the core, the trim or core readings, which strip out the volatile items within the basket.
Okay.
And that's where the devil is, right? Like that's where the problem is.
Right.
So like looking at the CPI number right off the bat, 1.7%, you think to yourself, wow,
we're in a great spot.
Ammunition for the Bank of Canada to reduce interest rates on June 4th.
Right.
There are a few things at play right now in the Canadian economy. The argument to drop interest rates in June is supported by the weakening Canadian economy, right? We've got an unemployment reading that came out showing that we lost net like over 30,000 jobs. Our unemployment number went from 6.7 to 6.9%.
Okay.
That's ammunition for dropping interest rates. Consumer confidence is just getting hammered right now.
Mm-hmm.
And that should also support dropping interest rates.
I'm ready for the butt here.
On its face, a 1.7% CPI print for April should support dropping rates. But when you dive into the core CPI and strip out its energy, because of the removal of the carbon tax pricing,
right?
Energy dropped 12, I have the number here, 12.7%.
Right.
So the issue is when you strip out that drop in energy pricing and you look at the Bank of Canada's preferred gauges of inflation, which are CPI trim, CPI median. So the difference between these two is very little. It's kind of nuanced, but CPI trim takes out the top 20%, so the 20% of the most volatile to the upside of the items in the basket and 20% of the most volatile to the downside in the basket.
Okay.
And it gives you a reading excluding these volatile items, which is what the Bank of Canada looks to and relies upon. Let's pull up the chart that it's on the Bank of Canada's website. So let's look at this while I'm talking. So this is showing us this is showing us trim CPI and median CPI.
Okay.
Again, trim CPI strips out the 20% that are volatile to the upside and the 20% that are volatile to the downside. And then the median number is just like the 50th percentile of the basket of goods. So just kind of cruising along through the middle, excluding all of the items like energy, which is like did totally drag down CPI for the month of April. Because the Bank of Canada doesn't like one-time factors influencing, the basket of goods for the decisions. And you can see if you can even kind of play with that cursor on the bottom to tighten it up. And if you look at like kind of from January of 2022 to today, you can see that like in the summertime of 2024, we were well within that range and we had this really nice trend where we were going into the sweet spot for the Bank of Canada. Now, more recently, we're edging higher and we're heading outside of that range. We are currently outside of the comfort range.
Mm-hmm.
What's more important is the trend, right? The last few months have all trended higher.
Right.
The increase from April is one of the big ones was travel and tourism.
Right.
So, and I think that some of the things I'm reading, it relates to this like elbows up, stay in Canada.
Yeah. Travel local. Yeah.
And then the other thing is grocery prices, which I have an idea for, which I want to talk about today.
To save Canada from high grocery prices?
Remember when I said to you over the phone, I was like, I got an idea that I don't know how it's going to play out. Let's talk about it in today's show.
Yeah.
So we're going to bring it up. But what I want us to understand is that when trim CPI and median CPI come in at 3.1 and 3.2 respectively, like we're seeing there, it hurts the probability of a rate cut from the Bank of Canada, especially when it looks like the trend is going higher. So even though we've got an economy that is like just the chart for our economy would be like a
straight jump off the
I mean, it would be a pretty accelerated curve to the downside. And you can see in a lot of the economists' response to the CPI number the same view of those numbers. I can quote two. There was a good article in Better Dwelling where the author says, on one hand, the Bank of Canada is seeing rising unemployment and weak household consumption, which should slow inflation. But on the other, credit growth has been robust and inflation is outside of the target.
Right.
They add like a little, Better Dwelling is always like a little bit cuter than everybody else. Like they're willing to kind of stoke the embers of the kind of economic dialogue within Canada. And they add to it, they say, it would be bold for the central bank to dismiss rising inflation as a transitory trend twice in less than 5 years, but not surprising. And they're referring to the fact that just coming out of the kind of COVID stimulus and during the COVID stimulus period, the Bank of Canada said inflation was transitory and we had nothing to worry about. And then we ended up into this like massive.
Yeah.
Now, I've voiced my concern on this in the past. And I guess like, you know, this sounds weird, but the reason why this time is different is because of the unemployment. So because we're in a period of rising unemployment and one-time inflationary pressure from tariffs, it is unlikely that the impact that inflation, the tariff impact of inflation will become systemic in the economy because it only becomes systemic when you increase wages.
Right.
And with decreasing employment utilization, with increasing unemployment numbers, it's more difficult to see wages increase, right? There's not going to be the same scarcity for labor force if more and more people are unemployed.
Right.
As a result, I think this should help the Bank of Canada with a rate cut. Listen, I still think we're going to see 3 rate cuts in 2025. It's just a question, like the June one becomes a little more difficult to predict. Like for instance, I think the probabilities of it are now down to 40% where they were at like closer to 70% that we were going to see a rate cut. Another one, so another similar line was there's in a Globe article, CIBC's economist says, signs of renewed weakness in the economy on one hand, as shown by the latest employment data, but stronger core inflation on the other hand makes for a tough decision for the Bank of Canada. So just to let you know, everyone's thinking about these two kind of opposing factors in their decision right now for the Bank of Canada, right? Like they're saying, okay, well, like on one side, the economy sucks. Unemployment is increasing. But on the other side, tariffs are causing inflation. Is it tariffs? Right? Is it really all tariffs? I don't know. I can tell you that grocery prices were going up before tariffs.
Right.
So Loblaws and Sobeys, the kind of very dominant player in Metro, the very dominant players in our oligopoly of groceries here in Canada, are seeing really good numbers on the backs of Canadian consumers. Grocery stores were 3.8%. So groceries were a 3.8% contributor to inflation for the CPI number, up from 3.2% last month. And again, the third consecutive month of increases. Vehicle prices were up like almost 1%. That's for sure tariffs.
Yeah.
Because they don't want to be passing that on. They're already probably having a really difficult time
Keeping it down. Yeah.
Now, Mark Carney, who was a Bank of Canada governor at one point and is now our prime minister. And this is pretty, like, I'm going to ask you whether you knew about this or not. Did you know that we walked back almost all of our tariffs on the United States?
Really?
Yeah.
I did not know that.
Yeah.
I did not.
So
did they walk back ours? No.
No, they're walking all over us.
Yeah.
But
I mean, we're going to be under the Golden Dome now, so.
So Oxford Economics issued a report where they said that by walking back the tariffs on the bulk of the American goods entering our country, we actually are doing something to help our economy.
Right.
Because we won't be seeing inflationary pressures to the extent that we would have expected.
Right.
I think, and it's obviously going to be way easier to assess this in the future, but I think that this is a good move. And listen, initially I thought you come out strong, you like punch them in the face, really go firm, like the Doug Ford, cut off the electricity. But when you have an opportunity to bring in a new prime minister and reset the relationship between the United States, and that new prime minister starts a bit of a reset by saying, like, okay, we're not going to retaliate. Let's just get to the table and figure something out. I think we may see that carry some favor with the Trump administration. I mean, Trump administration? It's just Donald Trump.
Yeah.
And he's already said that, like, he likes Mark Carney. Mark Carney's handsome and he's smart. And like Trump literally he selects world leaders essentially the same way you select Tinder dates. Right? Like he's just swiping left or right.
Yeah.
And if someone's handsome and smart, he is more than willing to.
And a good suit.
Yeah, he'll buy dinner. Yeah. He's going to buy dinner. Like Trump's buying dinner. He's expecting something, but he's buying dinner.
Nothing's free in this world.
So honestly, I think, and this is, again, it's a bit more nuanced, but I think that if and likely they are, if Tiff Macklin and Mark Carney are speaking, I think that there is an understanding that the impact of the tariffs will be more muted going forward. I think that we have a really good chance of escaping some of the pain that we expect. Mm-hmm. And hopefully that can happen relatively soon with the United States. But I think that it, for me anyways, gives a little more firepower to dropping the 25 basis points in the month of June.
Right.
That being said, central bankers are cautious, and our central bank was already burned.
Yeah, like it's nice that they're cautious now.
Right. And as a result, we could see a pause to July.
Right.
And frankly, 25 basis points is not going to resurrect the Canadian housing market.
Of course, yeah.
It's not going to help condos in Toronto get sold. I don't even know if 1% is going to do that. I think that is more a factor of the battered psyche of the Canadian worker and consumer. Mm-hmm. And I think that will only be supported when and if we reach a trade agreement with the United States. I think that whatever that agreement looks like, it's going to look different than what it looks like today.
Right.
It could be a little worse for Canada, mm-hmm. but I don't know if it's going to be all that much worse.
Yeah.
And if that happens, that is a driver for economic growth. I don't think it's a driver to the point where like we're going to have to start thinking about hiking rates again.
Yeah, like where we're just booming.
Yeah, like I think we're going to go down. I think we're going to go down at 75 basis points to 1 percentage point from where we are right now. So the prime rate's at 4.95. I think we're at again, sub 4%.
3.95.
A 3.95
Yeah,
prime
you heard
rate.
it here first.
Yeah.
Yeah.
And you can still get some good variable rate product. You told me the other day, like there's stuff at like 55 below prime.
Yeah, 100%.
On the uninsured stuff.
Yeah, we can get you to 55, 65, something like that below prime. Yeah,
Okay.
it's not bad.
So that's great, right? Listen, I've been saying this for a while. I'm a strong advocate for the variable rate mortgage. So the inflation number coupled with the rising bond yields in the United States are affecting bond yields in Canada. We can pull up the 5-year Canada bond yield. And when you look at it, you'll see like we're kind of 30 basis points higher than where we were.
Yeah.
That's going to result in increased pressure on 5-year and 3-year fixed rate products.
I mean, the pressure's there already.
Yeah. So in this short term, you're going to continue to see elevated fixed rates. I wouldn't take a fixed rate above 4%.
Yeah, and we can still get that. Like we're still under 4%.
I'm just saying, like 4% is 95 basis points below prime right now.
Mm-hmm.
You're going to get those 95 basis points within the next 12 months, probably sooner.
Mm-hmm.
So wait and take them one by one, and don't be in a product that locks you in.
Right.
So yeah, that's really what I had to say. Employment numbers and the resetting of our tariff conversation with the United States should be super helpful. Should be super helpful for the Bank of Canada to drop interest rates in June. Again, I don't know if they will. But again, the Bank of Canada is going to have a little more data than we have up until to the June 4th date. And I think whatever they're going to look at, all of it's going to signal drop rates.
Okay.
With the exception of that one reading. And if I can do my part, I have an idea.
Okay, I was waiting. It sounded like you were wrapping things up. And I was like,
No.
if we end this podcast before figuring out what the minister of grocery stores would do, if that was a position.
Okay, so here goes.
Okay,
here's my idea.
Okay.
And I've only really had the time to analyze 2 companies for this.
Okay.
So, and they're the easiest to do. So Loblaws and Sobeys.
Okay.
So within the Loblaws
I feel like I know where you're going with this.
within the Loblaws banner,
Okay.
there are like Loblaws, No Frills, Great Canadian Superstore, Shoppers Drug
Independent
Mart.
City Market or whatever.
Yeah.
Yeah.
Within Sobeys, it's like Sobeys, Freshco,
Longos?
maybe.
No, maybe, yeah, okay.
I don't know. Anyways, these are 2 huge grocery store chains, operators, part of the oligopoly in Canada.
Mm-hmm, mm-hmm.
Both of which have real estate arms. So a while ago, it became very efficient for companies to silo what they do.
Mm-hmm.
And in the case of Loblaws and Sobeys, the decision was like, let's strip out all of our real estate and put it in a REIT.
Mm-hmm.
And let's keep our core business separate from our real estate business. Both Loblaws and Sobeys have massive real estate businesses.
I could imagine.
Massive.
Yeah.
Loblaws has a REIT called Choice, and Sobeys has one called Crombie. Okay. So first, let's look at Choice, okay? Is this Choice? This is the bigger one, 10 billion. Yeah. Okay. So trading at $14.50, $14.69. If you look at the 5-year chart on it, you're going to see that there's some downward pressure, but not much. Like it's kind of, look at the all. Let's see what the all-time high on this thing was. Like we're pretty close, right? Like the stock has been behaving really, really well.
Mm-hmm.
And because the tenants are mostly these grocery stores.
Mm-hmm.
However, and if you want to pull up the other one, you can pull up Crombie REIT also. Again, funny, it's like also $14, right?
Mm-hmm.
But again, it's about 25% of the size. Okay. These guys within these portfolios have massive, massive amounts of real estate holdings.
Okay.
Choice has $17 billion in holdings.
Mm-hmm.
And Crombie has $6 billion in holdings.
Okay.
They have
Chump change.
chump change for you, but you know,
For some.
yeah. For these publicly traded massive companies. But the fact that interest rates are high and need to be lower is a concern for the real estate side of these businesses. So for Choice and for Crombie. And I'm sure like these guys also have massive developments that are underway. They own, massive pieces of property, like Loblaws is doing that whole development. They own all of Dundas and Bloor, where there's a Loblaws store there in the city of Toronto. For those of you that watch us from Nunavut, I know we got a strong cohort in Nunavut. Anyways, if the real estate market could improve a little bit in Canada, these REITs would see great growth. But Loblaws and Sobeys would have to take a hit. So what I wanted to look at, I looked at how much money Loblaws and Sobeys make. So do you know how much Loblaws sells in groceries annually?
I don't even know.
Do you want to guess?
5 billion? 500 billion?
500 billion. It's ever between 5 and 500. Okay, do you know what? You're 100% correct. It is somewhere between 5 and 500 billion.
Hey, I knew it.
Yeah, it's 40 billion.
40
so 2024, they sold $40 billion worth of groceries. And this includes Shoppers.
There's a lot of Pop-Tarts.
Right. Their gross margin on those groceries was 30%.
Okay.
30%. Like $1 out of $3 was margin. The net margin is obviously when you strip out more of their expenses, gets them down to about 5%. Sobeys actually not as well run. Maybe it's because they don't make as much. Who knows what the reason is? But they sell $30 billion worth of groceries. Their gross margin number is 26%.
They're just not as good as jacking everybody on bread.
I guess so. Yeah.
Yeah, that's the issue.
The price fixing.
Yeah.
Mind you, they kind of work together. Anyways.
Yeah.
So Sobeys has a 26% gross margin and Loblaws has a 30% gross margin. And our biggest concern is that food price inflation was at 3.8%. And listen, Loblaws and Sobeys, here's my proposal. If you can help us, all of us in Canada, get that pesky food. I'm not going to name any names, Loblaws and Sobeys. I guess I am. But if you can help us by reducing the contribution that you are making to food price inflation from 3.8% to get it to 2% within the Bank of Canada's targeted range, you would only lose 1.8% off of your gross margin number. And in exchange, we believe, Canadians, and I thought we were all in this together with our elbows up, we believe that by foregoing about 2% off your gross margins, which, like, honestly, in Loblaw's case, like, we're only talking about like $800 million. Like, whatever.
Again,
right?
chump change.
Yeah, it's nothing. $800 million.
Yeah.
I believe that your massive portfolio of real estate would see a significant appreciation within Choice Properties and likewise Sobeys in Crombie. So I'm not asking you to do it for nothing. I'm saying that if we really are all in it together, reduce your gross margins. Maybe the government of Canada, I mean, I know this is probably totally unheard of, but maybe they can collude a little bit with the grocery stores to help them in some way to mute the impact of the reduction in their gross margin. And in exchange, maybe the real estate market will do better because the Bank of Canada will be able to drop interest rates for us.
I think this is a great idea.
It's harebrained. This is like, honestly, on the way to communism. But I don't know.
Ottawa was communism. This would be like Kingston.
This is like, communism light.
Yeah.
And I don't know why I go towards this. Because I don't know if you remember, I said this a while ago that we should nationalize oil production. Also a bit of a kind of, socialist agenda. But I just think this is obviously just a funny idea. When you see just the size of these companies that we've created, it's the argument for why, like when you let certain companies just get so powerful, it's why the next, like once companies get so powerful and so profitable at the expense of the consumer, of the public, that's what eventually, it's not just companies, right? It's like in the olden days, it would have been families or a feudal system or a king. And then eventually there's a revolution. Mm-hmm. And I think like we're obviously a ways away. If you spoke to Ray Dalio, he would think we're way closer. But we are trending in this direction where we continue to give more and more power to these corporations that are really well organized, have incredible lobbying power, and are able to kind of continue to draw and suck more out of the consumer.
It's like a black hole.
That if you can't have some way to keep that in check, you are definitely going into the wrong direction. So all of this is to say, I mean, listen, the other problem with all of this is like, it's not just like one guy at Loblaws and one gal at Sobeys. This is, these are publicly traded companies that have to answer to the shareholders. The shareholders have purchased these companies because of those gross margins. So if you're sitting there right now watching this and you're saying, and like, okay, like some mortgage broker with an economics degree right now is going to try to tell us to reduce the gross margin number at Loblaws, get out of here.
Yeah.
Anyways, it was just my fun thought for the day. In conclusion, CPI looked like it was really good, but it ended up sucking. And it was going to be a good reason why the Bank of Canada could cut rates, but now it might end up being a reason why they hold, although I don't think so, because of the muted impact of tariffs and the unemployment numbers. And I hope you enjoyed today's show, and thank you for the comments and the emails that we've been getting. Mm-hmm. There was one really good comment on the last one. Did you see it?
No.
It was like, we were talking about the condo crisis in Toronto, and somebody wrote, "Oh, great, another two whatevers talking about condos."
Really?
Yeah.
What was the whatevers? Oh, it was literally said
like,
whatever.
Like what's two nobodies?
Two morons.
Yeah. So today it's another two whatevers talking about CPI and whatever.
And how to save the real estate market in Canada.
But like, thanks. We really do appreciate all the support we are getting. So thank you very much. And until next time.
Thank you.